Hello everyone and welcome again to my How To Education channel. As I promised you last week, today we're gonna solve as many exercises as possible concerning the Working with Financial Statements lecture. After watching this video, don't forget to leave me your feedback. For question number 1, we assume the following data. Sales $3,000, net income $1,200, net fixed assets $2,400, current assets $1,500, inventory $600, and interest expense $36. We need to find the common size statement value of inventory. Inventory appears only in the balance sheet. Therefore, the common size statement asked for is the common size balance sheet. In a common size balance sheet, all accounts are displayed as a percent of total assets for the current year. Thus, the common size value of inventory equals 600 over 2,400 plus 1,500, all of it times 100%. Which is 15.385% or 0.15385. For question number 2, we assume the same given as number 1, and we need to find the common size statement value of interest expense. Interest expense appears only in the income statement. Therefore, we need to use the common size income statement. In a common size income statement, all accounts are displayed as a percentage of total sales for the current year. Thus, the common size value of interest expense equals 36 over 3,000 times 100%, which is 1.2% or 0.012. For question number 3, we need to find the price-earnings ratio given that annual sales equals 110,000, number of shares outstanding equals 5,000, profit margin equals 3.75%, and price-sales ratio equals 0.6. The price-earning ratio equals to the market price per share over earnings per share. So let's find earnings per share and market price per share. Earnings per share equals net income over number of shares outstanding. Number of shares outstanding is given to be 5,000, and net income equals to the profit margin times annual sales. So 0.0375 times 110,000 over 5,000. Earnings per share equals $0.825. The market price per share equals price-sales ratio times sales over number of shares outstanding. So 0.6 times 110,000 over 5,000, which is $13.2. Thus, price-earnings ratio equals $13.2 over 0.825, which is 16. For question number 4, assume the following. Long-term debt ratio equals 0.3. Current ratio equals 0.7. Current liabilities equals $350. Sales equals $2,220. The profit margin equals 4.5%. The return on equity equals 10%. And calculate the value of the net fixed assets. So, to begin with, current assets equals current ratio times current liabilities. So 0.7 times 350, which is $245. So current assets equal $245. Net income equals to the profit margin times the sales. So $2,220 times 0.045, which is $99.9. The total equity equals to the $99.9 of net income over 0.1, which is the return on equity. So total equity equals $999. 0.3 is the long-term debt ratio. The long-term debt ratio equals to long-term debt over long-term debt plus equity. So 0.3 equals long-term debt over long-term debt plus 999. So long-term debt equals 428.143. Total debt equals current liabilities plus long-term debt. So total debt equals 350 plus 428.143, which is 778.143. Total assets equals total debt plus total equity. We have total debt and we have total equity, so total assets are equal to 1,777.143. The net fixed assets are total assets minus current assets, so the net fixed assets are 1,532.143. For question number 5, we are given the values of cash, account receivable, inventory, and net fixed assets for 2008 and 2009. We're also given that 2008 is the base year, and we need to find the common base year value for the account receivable. The common base year value for any account is its current year value over its base year value. So, the common base year value for account receivable equals current year value of account receivable, which is 90, over base year value of account receivable, which is 100. Common base year value of account receivable equals 90 over 100, which is 0.9. For question number 6, we are given the cash, account receivable, inventory, and accounts payable values for 2008 and 2009, and are asked to see what effect did the change in net working capital have on the firm's 2009 cash flow. Well, from 2008 to 2009, cash increased by $20. When current assets increase, we always put a negative sign. Thus, it is equal to minus 20. Accounts receivable increased by $12, so minus 12. Inventory decreased by $60, so plus 60. Since every time current assets decrease, we put a positive sign. Now, the accounts payable increased by $100. Every time current liabilities increase, we keep the positive sign, so plus 100. Therefore, minus 20 plus the minus 12 plus the plus 60 plus the plus 100 equals 128. Since the final answer is positive, it is a net source of cash of $128. For question number 7, we are given that Tobin's Q equals 0.8. The replacement cost equals $187,500. The debt market value equals 91,000. The number of shares outstanding are 17,000 and the book value is 1.53. In order to find the market to book ratio, one must do market value per share over book value. We already know that the book value is 1.53. The market value per share is the market value of equity over the number of shares outstanding. The market value of equity equals to the market value of assets minus the net market value. The market value of assets equals to Tobin's Q times the replacement cost. Therefore, market value of assets equals 150,000. Market value of equity equals 150,000 minus 91,000. Market value per share equals market value of equity over number of shares outstanding, so 59,000 over 17,000. And the market to book ratio equals 3.47 over 1.53, which is 2.27 times. For question number 8, we are given the values of sales, price earning ratio, profit margin, and the number of outstanding shares. and we need to find the price-sales ratio. The price-sales ratio equals to the number of outstanding shares times stock price over sales revenue. We already have sales revenue and the number of outstanding shares from the given. Thus, we need to find the stock price. The stock price equals price per earning times earnings per share. Price per earning is 6 according to the given, and earnings per share equal to sales times profit margin over number of outstanding shares. So the stock price equals to 6 times 80,000 times 0.011 over 3,500. Thus, stock price equals to 1.51, and the price-sales ratio equals to 3,500 times 1.51 over 80,000, which is 0.066. For question number 9, we need to explain the advantages of using the price-sales ratio in comparison with the price-earnings ratio. Well, since sales are always positive, the price-sales ratio will not present any problem. Nevertheless, earnings can be 0 or less, making the price-earnings ratio to lose its value and making the price-sales ratio seem like a better option. What is more, price-sales ratio is not affected by any tax or expense that a firm needs to incur. Thus, price-sales ratio is very useful when analyzing firms whose earnings are 0 or less, or firms that have a lot of expenses to pay. Both ratios will be useful when earnings are greater than 0. Question number 10 requires us to explain a bit about the Tobin-Skew ratio. The Tobin-Skew ratio equals to the market value of assets over the replacement cost of these assets. A low Tobin-Skew, as in between 0 and 1, means that the cost to replace assets in case of damage, for example, are greater than the value of these assets. Thus, the stocks of this firm are undervalued. A high Tobin-Skew, as in greater than 1, implies that a firm's assets are worth more than what is needed to replace them, which implies that the stocks will be overvalued. Nevertheless, it is important to note that the information used to calculate the ratio might not always be accurate. This is it from finance for this week, but if you have reached the end of this video, it is because the content was helpful to you somehow. If this is the case, then please give your friends and acquaintances the opportunity to have access to these videos by liking, sharing, commenting, and subscribing to this channel. We will be continuing with more finance next Friday, but before that, I will see you all on the weekend with my personal experience account on how to provide a good tutoring service. Thank you so much.